Okay, I want to give you my take on the market. I have to chuckle. CNBC, for the first time, is starting to talk about bond yields. You talk about letting a horse out of the gate. Are you nuts? I've been talking about the bond yields since 2008. Okay, what do I mean by that? Here's the stock market 2008. Let me bring this down just a little bit, like this. And I'll explain to you. There's a couple indicators that identify for you when the market is falling apart internally, because they teach you, or the jibber jabbers on these TV shows make you believe the stock market, okay, is the economy. They do that on purpose. That way they can mask the economy. Give you an example. We can find out if it's good or not, the economy, if it's imploding while the market's running. In 2008, when they started to do QE, give money away free, so the stock bond buying would start coming in, here's what was happening. From 2010 up to 2015, up to this point right here, okay, 2015, remember what was happening. From 2008, the market went up 230%. But here's what we noticed. The bond market was going down like this. The yields were crashing. So that told us that the market internally was really bad. They were masking it by telling everybody the stock market is reflected of the economy, which is a lie. The stock market does not reflect the health of the economy. And the bond market told us that. 2015 is where they decided to raise rates. Remember that? 2015, they started to lie and say, oh, we're going to raise rates because the economy is really, really strong. Strongest economy in the world, strongest payrolls in the world, strongest everything in the world. Remember that? And I said, wait a minute. That's not true. Look at the yields. They're dropping. The bond yields are dropping. As a matter of fact, they're starting to invert, meaning that the 3-month rate started to go up and the 10-year yields were going down. So I said, this is nuts. So they started, and they went with their first rate hike, remember, on 2015, quarter point. And then all of a sudden they kept raising rates, and all the way up to until September of 2018. Okay, so while they're raising rates to 2018 up to here, so from here, okay, up to here, they're raising rates. As the rates were going up, okay, we saw the stock market was going up as well, okay? And they're telling us that's because the stock market, the economy is so strong that they can take those and engulf those rate hikes, absorb them. Well, here's what we saw. That was a bunch of nonsense. We saw, again, the bond yields were going down. And then we saw in October the market crashed 20%. It could not take those rate hikes. The reason why they knew it couldn't take the rate hikes, but they did that for one reason, to fake everybody out. When rates go, when you have the bond yields go, when you have the rates going up, okay, and the dollar will also follow. Okay, so it'll look like, well, strong dollar, it's got to be a strong economy. But people weren't buying the dollar. Okay, here you had the yields going up, you had the yield going up. The dollar was going up not because it was a strong economy, it was going up because all the economies around the world were going down. So we had the best, everybody was looking at our economy as the best dirty shirt in the hamper. So they're dumping their euros, dumping their Aussie, dumping the yuan, they're dumping all those and coming over here and buying our dollar. Now we get to 2019 here. Now let's go to January. When the market crashed, now we go to January, and you see over here the market in January right here. Well, that was the market right at this point right here, right on this chart. I'll put it right here, the market right here. And the market went from January up to May here, okay, after the crash, right? So there's the market going up. But guess what we saw? See this brown line? We saw the same thing as we saw back here. See these red lines? We saw that the bond market, the yields were going down. They're going down, just like here. So even at the end, they were lying. They were pushing the market up, all with stock buybacks. So everything was happening, all this movement from 2008 to 2015 was all stock buybacks. 2015 to 2019 to a crash in October, all stock buybacks. And then when they rallied the market up after the October crash 20%, they rallied it back up 20%. Well, you could see the bond market was going down. You can see it right here in brown. So everybody should have been saying, look, I'm going to stay long with my stocks, but I'm going to be very, very careful because these stocks are going to collapse. And that's what happened, and that's what we're seeing today. But today's the first day. We need to see a follow-through. That's what we need to see, is a follow-through. So tomorrow is going to be an interesting day. And tomorrow morning when the market opens, it's going to be very interesting to see how they handle the opening. Because, again, we want to see if they're going to open up tomorrow morning. The plunger team comes in and the applied opens up 45, 55 points to the good, where they rig it to the upside, where they buy index futures in the morning. Are they going to do that? Or is it the damage is done and they're going to have another down day tomorrow? Well, we won't know that. The only thing I'm a little worried about is we went straight down. I don't like that because those can create quick pullbacks. Okay, these could snap all the way back up again like this, called V-shape, right? I'd rather see where the market goes down, snaps back, down, snaps back. These are called lower highs. That's a more solid of a downtrend than straight down. But we'll see tomorrow morning, okay, if we get a follow through. That's the key. All right, so join the gang, okay, and let us help you with this. This is what we do. We don't just sit there and listen to Payne and Maria Bartiromo, how everything's wonderful and the world's wonderful and everything's great. Our gang members, we do a lot of work, and we watch the bond market. We watch all the indicators. We watch the durable goods. Don't forget, the biggest thing is you have your 4 indicators that nobody pays attention to, that we watch like a hawk. Your housing starts. We watch the pending sales. We watch your durable goods. And the big one, the yields on the Treasury. Are they inverting? Are they flattening? Yes, they were flattening from 2008 all the way up to 2015, and then they started to invert even worse. That tells you a crash was coming and a recession, and you can see that today, hopefully, this is the start of it. We'll see. We'll see. Okay, so join my gang. Go to philsgang.com, sign up, and again, if you're out in San Francisco, don't forget to stop and visit us in San Francisco at the Money Show. We'll be out there August 16th and 17th. Okay, see you on the charts.